You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. The labor market is at the foundation of the Fed's models for understanding inflation and overall economic activity. But throughout the last 2 years, labor market data have seemingly told inconsistent stories about job growth, labor market tightness, and compensation. Some analysts claim the data show a recession is just around the corner, while others point to signs that the labor market is as strong as it has been in decades. On today's episode, we talk with Preston Mui, senior economist at Employ America, about how to better understand the nuances of labor market data, how labor market tightness factors into Fed policy, and the outlook for 2024. Stay tuned. Coming up soon, our interview with Preston Mui, senior economist at Employ America. But first, a quick market update. This morning's March employment report showed continuing resilience in the labor market, with payrolls increasing by 303,000, the unemployment rate ticking slightly lower to 3.8%, and average hourly earnings growth rising to 0.3%. As you'll hear from our interview this episode, there are many different ways to read labor market data. Our general sense from this report is that there are still no signs of an economic downturn on the horizon. Earlier in the week, Chair Powell stuck to his recent message emphasizing the Fed's need to see more confidence in lower inflation before starting to cut rates this year. Still, his insistence on the Fed's willingness to eventually cut rates later this year, and that 2 months of worrisome inflation data haven't changed the overall outlook, are a notably dovish contrast to other public appearances from Fed officials like Minneapolis Fed President Neel Kashkari that are leaning towards a much more extended pause in Fed policy. We take Powell's words as the de facto median within the FOMC for now, but we'll have to wait and see how this morning's data and next week's March CPI might change the needle. The second revision to Q4 GDP data pushed up measures for overall growth from 3.2% to 3.4% and tweaked the core PCE inflation number from 2.1% to 2.0%. The data are, of course, backward-looking at this point, but still show the economy was on solid ground heading into 2024. Also last week, the February PCE report showed inflation came in largely as expected, but personal spending grew almost twice as quickly as expected. The ISM surveys earlier this week gave mixed signals for economic activity in March. Treasury yields stayed within relatively narrow ranges, but pushed higher on Monday after the ISM manufacturing report showed surprising strength. The bond market sell-off also reflected some delayed trading after an appearance from Powell and the February PCE happened on Good Friday when the U.S. financial markets were closed. Yields pushed to new 2024 highs earlier this week before settling down by a few basis points. The tragic collapse of the Francis Scott Key Bridge outside Baltimore has rerouted freight traffic to other ports on the eastern seaboard and even out west. Time will tell how flexible the U.S. logistics system can accommodate this change and what it will mean for U.S. consumer prices. The Port of Baltimore was particularly important for automobiles and coal before the bridge collapsed. That's all for the market update this time. Now, our interview with Preston Mui. Our guest today is Preston Mui, senior economist at Employ America. Preston, thanks for coming on the podcast.
Happy to be here.
Our topic today is the labor market, how to understand the vast amount of data we get every month, how the Fed factors those reports into monetary policy, and the outlook for 2024. I think it would be helpful to start with the monthly employment reports that come out the first Friday of every month, sometimes the second Friday. I'd say the main focus is usually on three main indicators: the monthly growth in payrolls, the unemployment rate, and average hourly earnings. So let's start by digging into the first two. The job growth numbers come from what is called the establishment survey, and the unemployment rate is calculated from the household survey. Preston, can you walk us through the differences in these two surveys?
Yeah, so as you said, the data generally comes from two different monthly surveys that the Bureau of Labor Statistics conducts, the Household Survey and the Establishment Survey. These two surveys are conducted completely independently. So even though they both measure the state of the labor market, they don't necessarily match up with each other. And I think the really important thing to keep in mind here is that these are surveys and they're not censuses. So they're basically a small random, not small, but they are not a complete look at the whole universe of either households or establishments. And so when you try to get a picture of what's happening in the aggregate economy, it can be a little bit tricky. So let's start with the household survey. The household survey is also known as the current population survey. It's a monthly survey of 60,000 households, which is about 100,000 individuals. And this is basically the Bureau of Labor Statistics going to people and saying, do you have a job? And by do you have a job, what I mean is, did you do any labor in exchange for income? The establishment survey is a survey of about 120,000 businesses, and they go to the businesses and say, how many employees do you have on your payroll during this particular pay period? And as I said, these are both surveys, not censuses. So the way that they scale the responses to give you a number that's like 100,000 jobs this month, or the employment rate is 80 point whatever percent, is they basically use weights to scale the responses to an aggregate. So these are two separate surveys, as I mentioned, and they're completely independent. And so there are differences between them. Even if you had the universe of responses, there are important definitional differences to keep in mind here. The first is the household survey will include people who are working on farms, people who are self-employed or working in private households. Those employees are typically not included in the establishment surveys. The other thing is that sometimes you have multiple job holders. So if I go to you and ask, are you employed? And you have two jobs, you'll say yes, and you'll count as employed. But if I go to your employers, both of them will say, yes, I have an employee, and you'll get double counted in the establishment survey. There are also other differences, like the establishment survey asks about how many employees are on the payroll during a particular pay period, whereas the household asks about a particular week. That's a small difference. The Bureau of Labor Statistics puts out a data series, which is where they take the household survey and try to alter the data so that it matches the definitions of the establishment survey. But even then, there's still sometimes, or often actually, a difference between the employment numbers in the household survey and the establishment survey.
So sometimes the two surveys can tell different stories month to month, and I think your description is really helpful in giving some ideas for why that might be. It could be multiple job holders or self employed people. But there has been this divergence in the level of employment between the two surveys going back to, I think, 2022, when the household survey showed pretty sluggish growth and even plateaued a lot of last year, while the establishment survey keeps showing robust growth. So how would you explain the difference in these stories, and is one of them more authoritative than the other?
This is actually not a totally new problem. This has happened historically. In the late 1990s, we found out that the household survey was underestimating job growth. And during the early parts of the Great Recession, the establishment survey was overestimating job growth. And as I said before, these are surveys, they're not the census. And the way that you get from a survey number to an aggregate number is to think about using weights. So population weights or demographic weights in the current population survey, or like industry and state weights for the establishment survey. And probably what's going on is that one, or maybe even both of these surveys has an issue with the way they are weighting things. So in the late 1990s, it turned out that the census had underestimated the demographic weights for particular groups that had more cyclical employment. So that's why they underestimated employment during that period. During the Great Recession, there was an issue with the way that the Bureau of Labor Statistics was modeling the entry and exit of firms. This is also known as a birth to death model. And so because a lot of firms were going out of business during that time, the establishment survey was overestimating the number of employees during the Great Recession. If we look at today, as you said, there's been a divergence where the establishment survey is showing much stronger employment growth than the household survey. This really started sort of late 2022 and has continued into 2023 and now 2024, and it's just become even larger over the past few months. One hypothesis out there is that the household survey is currently underestimating the number of undocumented workers out there. These workers may be included in the establishment survey, But if the population weights in the current population survey are incorrect, then we're likely to be underestimating the number of workers in that category. That being said, the census that we do have, the quarterly census of employment and wages, suggests that there's actually an overcount of the establishment survey in mid 2023. I think it's going to be quite a few years before we find out for sure which one of these is right and for what reasons one or more of these is incorrect.
Adding to all of that noise that is maybe typical, or we can kind of explain using historical normalcy, so to speak, I think a couple things have come up in the last few years that really add to it even more. And I want to get your sense of whether you think the data is even less reliable than usual. So, one thing is that we've seen a much lower response rate in the surveys, which could add a larger statistical margin of error. But also, if the response rates are going down because certain groups are more unresponsive than others, that would distort it. But then the second thing is maybe more gig workers that aren't being picked up. So Uber Eats, Lyft, Uber drivers, all of that, are they potentially not being captured by these surveys in the ways that we would want them to be?
Well, I think it's probably likely that that category of worker is picked up in the current population survey. I think it's likely that someone would respond to that survey and say, yes, I'm doing labor in exchange for income. The thing I would worry about there is related to the demographics. If you think that the people working in these jobs are more likely to be perhaps undocumented immigrants that are underweight in the population survey, that could explain some of the difference there.
I now want to introduce this concept of labor market tightness that is important for how the Fed views the economy. Preston, how would you define labor market tightness, and what are the primary methods that economists and the Fed use for evaluating how tight the labor market is at a given time?
So labor market tightness, I think there's a number of metrics that you have to look at, and not every metric is going to tell you the same thing. And you basically have to take a weighted average of what all the different measurements out there are going to tell you. When you think about the Fed and the way that they talk about labor market tightness, they also use a number of metrics. The way I interpret the way they think about the labor market is there's basically three tiers of data. In the top tier are things like the unemployment rate, the prime age employment rate, and the job openings to unemployed ratio. In the second tier are things like the quit rate, the hiring rate, the rate of wage growth. And then in the third tier are things like soft data and surveys where you ask people, how hard is it for you to find a job now? You ask employers how many more employees you intend on hiring in the next year. I think this is sort of underrated in the sense that the Fed actually does care quite a bit about this, but market participants probably put less weight on it.
So, that definition of labor market tightness, as I understand it, it's when labor demand is pretty close to labor supply, because in a really weak economy, there's a lot of slack in the labor market. And so I think the metrics that you pointed to, the idea is that workers are, they kind of have some bargaining power with their employers to kind of call the shots, or they have some discretion over what kind of jobs they want to take. Is that a pretty good description of labor market tightness?
Yeah, I think that's a pretty good description. And when the labor market is tighter, you tend to see it in things like higher quit rates because they feel that they have better outside options. They're more comfortable quitting into unemployment or they're finding better jobs. You see higher hiring rates, you see higher rates of wage growth. Those are all consistent with the tighter labor market.
So, Chair Powell, earlier in the pandemic, focused on something that you just mentioned, which is the ratio of job openings to unemployed people. And this was a specific gauge for labor market tightness that it seemed like the Fed was monitoring. And I think this was helpful because if there were, in theory, more job openings ready to be filled than there are people out of work and actively looking for work that exist, well, of course, the labor market was, I think the term he used, unhealthily tight. So job openings come from the JOLTS report. And there was often some hesitation to rely on job openings or some of the other metrics in the JOLTS reports. And I know the BLS has a technical definition of what constitutes a job opening, but it seems to me that not all job openings are created equally. So one posting for a job that a firm needed to fill urgently yesterday is counted as one job opening, which is the same as an opening that Sure, if the company found the right person, it would be nice to fill. Maybe a posting online is stale and the company isn't still hiring. So, how much stock do you put into the job openings data in general or just versus the other JOLTS data?
I don't place a lot of stock in the job openings data. One reason, actually, to go back to something we were talking about before, is that the JOLTS survey has a lot of issues with the response rate. I think out of all of the main surveys that we pay attention to, probably the JOLTS survey has declined the most in terms of the response rate. It's a survey of about 21,000 units, so it's about a sixth of the size of the establishment survey. So the sort of data size and the response rate makes it a little suspect. Sort of more definitionally, as you're talking about, the definition of a job opening it's a little broad. Basically, they say if you're actively hiring for a position that is open and can be filled in the next 30 days, that counts as a job opening. Now, what does actively hiring mean? It can mean anything from I put something on the Facebook page, which is free, or I actively talk to a recruiter and have someone out there looking for candidates. Those are all counted as a single job opening. So the definition is a little fuzzy. It's a little hard to interpret. And there's also been a trend increase in the number of job openings over the past few decades. So to interpret the level of job openings as a measure of labor market tightness is, I think, a little bit suspect. A job opening is an option to hire someone, whereas quits, layoffs, hires, those are actual actions that have some, heft behind them. And for that reason, I put more weight on the quits, layoffs, and hires.
I think that rising trend is interesting to think about, and I can think of a number of explanations. So, for example, because online job boards have maybe become they have a lower marginal cost than they used to if you had to hire a recruiter to go out and fill a job opening. And so it makes sense that structurally, because of technology, the number of openings could kind of be exaggerated in the way that we try to think about labor market tightness. But now that we're in this, period where maybe a soft landing has already happened or it's just a few months away, I think this ratio has become a lot less important to the Fed, but it is interesting that they decided to place so much weight on it because the way you've described it, it doesn't sound very reliable. And I know Chair Powell is very careful with his words in the press conference about how he describes statistics that they're monitoring. Do you feel like this was given too much emphasis before and, it kind of moved markets or the Fed thinking a little bit too much earlier in the pandemic?
I do think that there was too much emphasis put on it. And as you say, they have, at least on the margin, moved away from it. If you go through the Fed speak over the past, say, year and a half, the amount of emphasis that they put on this particular statistic sort of fades away, and he starts emphasizing things like quits and hires more. He now really lists it as one statistic among many that he views sort of more equally, whereas in the beginning, this was sort of the main statistic that he was paying attention to. I think the reason why it got so much play was in cast your mind back to 2022, when we start seeing all this inflation kicking off. And the main sort of model that macroeconomists think about when trying to explain economic activity and inflation is the Phillips curve. But if you go to the unemployment Phillips curve, you kind of have an issue where even if unemployment is 3.5%, 4%, that's still the unemployment rate that you had pre-pandemic. And so it's a little hard statistically to use that to explain what was happening with inflation. Meanwhile, you have the vacancy rate or the job openings rate going up really, really high. And so that's a really appealing way to try to use the labor market to explain inflation. I think that's why it got so much play.
So I want to use this concept of labor market tightness to connect to the third indicator that I mentioned close to the beginning of the interview, which is earnings. And so in a tight labor market, if workers have more bargaining power, that means that they can negotiate higher wages. And so we should be able to see some sort of connection at some point between a tight labor market and higher compensation. So I'm going to get to the monetary policy implications of that in just a second, but let's talk about average hourly earnings. So it would seem that measuring compensation would be quite simple, but looking at a chart of this metric through the pandemic, you see there's a huge spike in April of 2020. And this goes to the fact that this is an average, which means that if lower paid workers leave the workforce, the average goes up, but people didn't get a raise as we would usually think about it. So the Fed and economists know about this and try to account for it. What can you tell us about the employment cost index in its effort to fight some of these distortions?
The employment cost index is basically an attempt to control for the composition of workers. You can think about it as like a CPI of labor. So when you look at inflation, the CPI takes these fixed weight baskets of goods and measures the weighted average of price changes. The employment cost index is basically the same. They take a fixed basket of labor and they measure the weighted average of wage changes or compensation changes. And so if you look at the employment cost index, it doesn't have this weird pattern during the onset of COVID and then when people are coming back into work where the average hourly earnings is being thrown off by composition effects. That's why people generally pay more attention to the employment cost index. If you look at these statistics now, it's less of an issue when employment is more or less stable in the way that it is now. You don't really have these composition issues going on, but the employment cost index is a useful check. The downside of the employment cost index is that it only comes out every 3 months. So that's why people still pay a lot of attention, and I still pay a lot of attention to what's happening in average hourly earnings because I only get quarterly looks at the ECI.
The Atlanta Fed also has this great wage tracker that breaks down compensation by categories like income group, job stayers versus job leavers, high skilled versus low skilled. And so there's a description of, quote, 12-month moving average of median wage growth. Are there any composition issues or other measurement quirks here to keep in mind? What does that description of 12-month moving average of median wage growth mean? How do we interpret it?
I think here it's helpful to understand how the Atlanta Fed wage trackers are constructed. They're based on the household survey. And in the household survey, a household is in the sample for 4 months, then they're out of the sample for 8 months, and then they're back in the sample for another 4 months. And the current population survey asks people about their wages and salaries during the fourth month and then also the last month. And so you get two observations for a household that are exactly 12 months apart. So that's where the 12-month growth comes from. Now, the neat thing about this is that you are observing the same person. So you are comparing apples to apples in terms of controlling for the same person. The real big downside about this is that it is a small sample. You get about 2,000 matched individuals with wage observations both this month and 12 months ago because not everyone is employed. Not everyone is employed both today and 12 months ago. And also, you're only looking at a quarter of the sample of households because you only ask a quarter of the households about their wages and salaries. And then basically what the Atlanta Fed does is they calculate the median of the distribution of wage growth. So that's where the 12-month median wage growth comes from. This lets you do a lot of cool things, like you can break down job switchers versus stayers, you can break down demographics, education. You can't do that with other data sources, but you do have to take it with a grain of salt because it is 12 months. There could be issues with recall. People don't always accurately report their wages and salaries. So it's a useful data point. It can be a little noisy. I would say you throw it in with the, as a you take an average of the data and this goes into that average. Something interesting to note is that there's a big difference between this and the ECI. You can think about the ECI as looking at a fixed basket of jobs, while the Atlanta Fed tracker looks at a fixed set of people. And so if people are moving from one job to another and getting a better job, you might see higher wage growth. You did see this recently. You see higher wage growth in the wage tracker than you do in ECI. And part of that is people moving up to better jobs.
So, considering all that statistical noise, I'm trying to think of all the different ways that composition effects might distort it. But I think you laid out a good description there of how it is different from the ECI. But for example, if someone, let's say, starts in the lowest income quartile and then moves up to the second lowest income quartile, are they counted there? I mean, throughout the pandemic, have you been looking at the Atlanta Fed wage tracker to get a sense of the overall economy, or are the noisy things so distracting that you really can't deduce too much about the health of the labor market?
I would say that I do pay attention to the Atlanta Fed wage tracker. I don't hang on every word every month because of the noise, but I think it is useful to, for example, take a look back over the past 6, 12 months and say, What is the narrative that this data series is telling us? So one example is I mentioned you could break down job stayers versus switchers. I think it was useful to look at the rapid wage growth of job switchers and think about what the narrative of the labor market was over the past 12 months. Now, if the Atlanta Fed wage tracker comes out with some number in the next release, am I going to say, the state of the labor market has really changed because of that last number? No, I'm not going to do that.
So job leavers, I can see a couple reasons for why that wage growth would be higher. One is that the people that have the power to get a new job with higher wages could be the higher productivity workers, but also to be in a tight labor market. That is how companies compete for scarce workers. And so it then leads me to this idea of how labor market tightness is something that the Fed saw as complicating its mission to bring inflation down to 2% as recently as last year. So, how do you explain that? I know you mentioned the Phillips curve earlier. Can you dig into why the Fed was worried for a while that the labor market was too tight?
To be clear, they still think that the um, labor market tightness does matter for getting back down to 2%, although the sort of extent to which they believe this has shifted over time. The tone has definitely softened a lot, but you still hear Powell saying things like, we still want to see some softening in the labor market. We expect the labor market to soften. That's going to be part of returning back to 2% inflation. But cast your mind back to 2002 and explain the whole sort of process of people thinking about the vacancy, the unemployment ratio, and tying that to inflation. And people really focused on this job openings to unemployment as this explainer of inflation. And I think a lot of the fear was that, well, the labor market's really tight and this pushes up wages. Wages are a big cost in production, and that's going to lead to inflation. And sort of the most dire predictions were that you might trigger some kind of wage price spiral, or you might unanchor inflation expectations. And I think the Fed was really frightened of that, and I think that's part of the reason why they were so focused on this. Now, to be clear, they never really totally bought into this story. So there were voices saying that you would really have to kill a labor market if you wanted to make sure that inflation comes down. The Fed adopted this viewpoint a little bit, but definitely not to the extent that some voices out there were saying.
I'll add, sometimes I get a question from some of our customers, why is the ideal unemployment rate not 0%? And the reason is how economists define different types of unemployment. So, the kind that the Fed doesn't really care about, they feel is natural in the economy, and they don't have a role to fix as policymakers, is frictional unemployment, which is people in between jobs, and then structural unemployment, which is people whose skills don't apply to today's economy. And so the last one, which is what we're left over with, is cyclical unemployment. So you get this idea of a natural rate of unemployment, which is, what is the unemployment rate when you only have frictional and structural unemployment? But that seems to differ every cycle. And so the Fed, I think, saw the unemployment rate punching through their estimate for the natural rate of unemployment and thought, okay, this is going to result in those unwelcome wage price pressures that you just mentioned, maybe a wage price spiral. And then look, over the last couple of years, we've had unemployment under 4% and inflation is coming down. And so do you think this just goes to a misunderstanding from the Fed, or maybe a difficulty of figuring out what a kind of equilibrium unemployment rate is for the economy?
I think it's definitely difficult to try to nail down what the natural rate of unemployment is, if there even is one. I think to the Fed's credit, they have really learned from the lessons of the past. You saw in the late 1990s, in the 2010s, unemployment continuing to come in below and below natural rates of unemployment, or then estimated natural rates of unemployment, without inflation rearing its head. And I think that current makeup of the Fed is really willing to take estimates of the natural rate with a grain of salt. They're really willing to and wanting to see unemployment really as low as they can get it, as long as inflation is under control. Like, they don't see it as per se a problem, which the Fed of the past actually did. So I think actually the way I would frame that is that there are estimates of the natural rate out there, but I think even the Fed does not really take that too seriously now.
As we record this at the end of March, which means we don't have the March employment data yet, the unemployment rate, like I said, has been under 4% for almost 2 years, which is really just pretty remarkable by so many metrics, considering that this has been during aggressive Fed tightening. Really, going back to the 1960s, unemployment rate under 4% is very good. Job growth has slowed a bit, but is still pretty strong. So the hard data look really good, but there's so many stories about massive layoffs and people talking about how tough the job market is. We had Claudia Salm on a few months ago to talk about the possible explanations for the divergence in sentiment and the hard data, but I want to ask about the labor market specifically. Why do you think there is so much commentary about the labor market being weak when the data would suggest otherwise?
That's a good question. Some other people have done work on. I heard recently interview with Aaron Sojourner and Ben Harris where they looked at the sentiment of news coverage of the economy and just in general reporting on the economy has gotten more negative in a way that is not necessarily tied to economic fundamentals. That seems to be a long trend that has continued into now. There may be some partisanship involved in particular areas of coverage. So I think there probably news coverage has something to do with it. I think there are some parts of the labor market that are not so pleasant right now. So if you're unemployed right now, it's a little difficult to get a job compared to, say, a year ago. I think that might be part of it. As you said, the fundamentals of the labor market do look very strong right now, and I think that's important to keep in mind.
I think that idea of news stories becoming more pessimistic is at least convincing to me because I think if you look at the employment data from the establishment survey, an industry that is doing very, very poorly, really struggling even before the pandemic, is media and journalism. And so it could be that the people who are writing the literal headlines are in a position where they feel their job security is threatened. And so they're kind of more primed to hear pessimistic viewpoints than, maybe someone in an industry that is doing very well. In any case, Fed officials have pointed to two things that have helped job gains the past year that have happened without causing the economy to overheat. So, higher labor force participation, specifically through higher immigration, and higher productivity. Do these forces play into your understanding of labor market strength right now? And do you think they can continue for the foreseeable future? Is there sort of just a bounce back after being depressed earlier in the pandemic, or are these going to continue for the foreseeable future?
So if you look at productivity and where growth has happened in late 2023, you see it's focused in things like real fixed investment, especially non-residential construction that's been buoyed by strong fiscal policy. You see it in consumer spending in durable goods, which points to the supply chain healing. So I think there really is something to be said for higher productivity that is tied to recovering from the pandemic. And also, I think underrated is that people have been switching jobs a lot over the past 2 years, and that has really calmed down recently. And it takes people a while to get used to their new jobs, to become productive in their new jobs. And so I think you're going to see that as people get settled into these new jobs, we might see some more productivity out of these new matches. Is the productivity going to improve in the future? I don't think it's necessarily going to slow in the immediate future. If you think about the supply chain issues that I mentioned, right now we're seeing it in goods, but eventually the healing of the supply chain should make its way into other, for example, services that are related to goods. So you look at automobile insurance, we're seeing really bad inflation in automobile insurance right now because there's feed through from goods and services and with a lag. And so we might start seeing it in other sectors of the economy later.
That explanation of job switching causing some unproductivity, I think it feels pretty convincing because for the first couple of years of the pandemic, when everyone was not only changing jobs a lot of labor market churn, there was also an adjustment of this new working environment, working from home, restaurants using QR codes instead of waiters, and all of that has clunky adjustment. And then once we get into a groove, it feels like productivity could really increase once people are more familiar and they're trained in this new setting. I also want to talk about a post that you had recently about demand-driven productivity, which is the idea that full employment, labor market tightness, can actually increase productivity on its own. Can you give us an overview of some of your main thoughts behind that analysis?
When it comes to full employment and productivity, There's three channels that I have in mind here. One is the first one that I mentioned, which is workers getting more used to their jobs and in higher productivity jobs. In the most recent economic report of the president from the Council and of the Economic Advisors, they do a cool exercise where they look at basically the quality of the jobs that people are in the current population survey, and you see that it goes way up after 2020 during the recovery. So as people get used to these new higher productivity jobs, hopefully that will spur productivity growth in the near future. The second thing is that you mentioned demand-led productivity, and what I have in mind there is that in order for firms to justify investing in technology, in capital, in research, they have to have expectations of demand. If firms don't expect there to be a consumer at the end of the day to buy their stuff, it becomes harder to justify expanding productive capabilities. So we saw in the 2010s that persistently weak demand led to underinvestment and low productivity growth. I think because that the recovery has been so strong this time and consumer spending is expected to continue to grow, this is going to spur productive investments by firms. And then the last one, which I was actually not able to find much evidence for, but I think may very well happen, is just that as labor becomes more expensive, firms are going to be incentivized to invest in labor-saving technology, and that's also going to improve productivity.
I think that's all a really interesting way to think about it, because I feel like we've heard the last few years this difficulty from businesses to hire enough workers seem to be really slowing capacity down, and the possibility that it was just an adjustment phase and then we'll have this boon of productivity in the future is certainly an encouraging way to look at it. So I want to end with asking you your outlook for the labor market this year, and I think if there's any takeaway from our conversation, it's that there is really no one metric or angle to look at the labor market. And so maybe to help guide your response, what is one thing that you think shows hopes for continued strength, and what's an aspect that makes you worried?
I think a useful way to think about employment is what we call the bathtub model, where you think about the number of employed people as the amount of water in a bathtub. And you have a spigot that's feeding into the bathtub and a drain that's going out, and the drain is people losing their jobs, and the spigot is people getting jobs. And so if you want to think about what's happening to the number of employed people out there, you have to keep an eye on people losing their jobs, so layoffs, and hiring, which is people getting jobs. And I think it's really encouraging that we, in the data, have really not seen any tick up in layoffs. You don't see it in unemployment insurance claims. You don't see it in the JOLTS data. You don't see it in the current population survey. So that's very encouraging. The thing that's less encouraging is that the rate of hiring really has slowed. So the hiring rate is now back to about 2014 levels. Part of this is related to job switching has just gone down. I think people are just well matched to jobs now. But the other part of it is that it's also a little bit more difficult to find a job if you're unemployed or looking for a new job. And I think that's probably the weakest part of the labor market right now.
Interesting. And so then your outlook for the rest of this year, do you think the soft landing will be sustained, or will we see a bit of weakening that goes into a larger downturn?
I'm pretty optimistic about the soft landing. Obviously no guarantees, but if you look at the most recent summary of economic projections and how the Fed is thinking about it, now 17 out of 19 members are projecting an unemployment rate of 4.1% or less by the end of this year, and we're standing right now at 3.9%. So that's not a very large increase at all. So I think it really shows that the Fed is committed to trying to achieve a soft landing, and as soon as they get that last bit of confidence that inflation is under control, they'll be ready to normalize policy.
Preston Mui, thank you for coming on the podcast.
Yeah, my pleasure.
That was Preston Mui, senior economist at Employ America. There is so much good information there about how to interpret the vast amount of labor market data we get every month. I think it's helpful to remember why some of the data series can suggest different things in any given month. One reason the Fed likes to take a longer-term view rather than relying on one monthly report. Also, now that the labor market is in better balance, the lower level of churn is helping boost productivity and keep wage pressures in check that, in turn, are making the Fed more comfortable to cut rates later this year. The data highlight during the next 2 weeks will be the March CPI report, out next Wednesday. After January and February inflation threw cold water on investors' confidence of inflation coming down to 2%, this report will be key in shaping expectations about whether the previous months were anomalous or a new underlying trend. The PPI on Thursday will also help shape expectations for the Fed's preferred PCE inflation, which will be released a few days before the May 1st FOMC decision. Also next week, we'll see the minutes from the FOMC's March decision. We'll be looking for details about how the members of the Federal Open Market Committee are viewing the inflation outlook after recent inflation data, the upward shift in projections for rate policy the next couple years, and the level of urgency in tapering the pace of their balance sheet roll-off. A handful of public appearances from Fed officials are on the calendar the next 2 weeks, though none featuring Chair Powell at this point. Treasury's coupon auctions resume next week with the 3-year, 10-year, and 30-year auctions Tuesday through Thursday. Auction performance has been fairly mixed since the last refunding announcement, but stronger than many feared considering the elevated Treasury issuance. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.